But why do they get involved? Well, the main reason for them to target a particular cash rate is if they felt like there was too much money in the system and maybe too much aggregate demand in the economy, or vice versa, or the opposite of that. And so if they thought there was too much, then yes, they would look to take liquidity out of that system. In so doing, that pushes interest rates up. Like with anything, when supply comes off, the price of the thing, in this case, the price of money, goes up. And if they think that there's not enough liquidity in the market, there's not enough aggregate demand in the market in particular, then they will add in stimulus, they'll add in liquidity, they'll cut interest rates. When we see the central bankers making decisions on interest rates, that's primarily what they're considering. Is there, because that's what they're impacting. They're impacting the amount of liquidity in the system and the cost of capital, cost of money. Now, they do also go beyond this more natural, organic mechanism towards impacting the economy, manipulating cash rates with liquidity in a market that they're involved in, that they're a part of. The other thing they might do is look at liquidity operations in other markets that they aren't traditionally involved in, that they don't necessarily need to be a participant in. This we've seen over the last decade or so, which we call quantitative easing, central banks jumping into longer term securities, not overnight interbank cash rates, but jumping into government bond markets, 1 year, 2 year, 3, whatever term bond markets. Again, the point is they're looking to target perhaps a yield, or at least look to manipulate yields up or down on these longer term securities. And these longer term securities are very important because these have a much higher link, let's say, to cost of capital within the economy. That is, if you need capital, debt or equity in particular, how much do you have to pay to get that? How much returns do you need to give to investors? And so targeting those long-term interest rates in particular has a very direct link to asset markets in general. But note that targeting of specific yields for central banks in other markets, longer term asset markets in particular, is much more difficult. There's a lot more other participants and a lot more difficult for them to add in enough liquidity or take out liquidity in order to get yields to where they might want them. But they can at least pressure the yields in the general direction that they want them to go. And so when they enter the markets and they buy up bonds, this is adding liquidity into the market, and this leads to a drop in yields, leads to stimulus in the economy. Cost of capital is cheaper now. Businesses can do more with less, let's say. And there is a flip side to this though, because central banks don't necessarily want to, when they buy bonds, they don't necessarily want to hold the bonds forever. They would want to sell them at some point, perhaps. And the reversing of quantitative easing, which we might call quantitative tightening, might occur. So back to that previous question, are we happy? Are we comfortable with central bankers manipulating money like this? Well, it's worked reasonably well for the last 30, 40 years. Unlike fiscal policy, central bankers aren't elected, therefore they're not necessarily driven by public appeal for stimulus in particular, or the opposite of stimulus, higher interest rates. They're not necessarily averse to that, though it is pretty clear that there's a lot of political pressure and social pressure that central bankers do get, usually asymmetrically. Like I said at the start, most of us are happy when interest rates are going down. Most of us are not happy when interest rates are going up.
Now, If you're a bit of a finance nerd like me, why don't you check out my Substack? There's a link in the description, and here you'll find additional concept notes, unedited videos, community chats, and much more. See you next time.